Alright my friends, Alphonso here. In this video, I'm going to show you the simpler way to identify market structure. If you are new here, subscribe to this channel, like this video for regular market analysis and Forex education. So market structure is the strongest foundation of technical analysis. It illustrates who is in control in the market. It is used to identify the trend of the market. So understanding market structure across different time frames is a whole new skill. The market is usually doing one of the two things, either trending to the upside, that is uptrend, or trending to the downside, that is downtrend. Or the market can be consolidating, what we call ranging or a choppy. You should also understand internal structures in order to avoid smart money traps, avoid trading fakeouts. So let us go to the charts and see the illustrations of different types of market structure. An uptrend market structure forms a series of higher high, higher low, higher high, higher low, higher high, higher low, higher highs. So these are the higher highs. So these are the higher lows. So the market cannot go straight to the upside this way. No, it has to come for a pullback. Higher high, a push, then a pullback, a retracement, which is higher low. We are breaking this structural high right here. We are breaking that structural high to the upside. We are again breaking this structural high to the upside. We are breaking the structural highs to the upside this way. So this is a typical uptrend market structure, BOS, break of structure to the upside. We are breaking these structural highs. When resistance is broken, it becomes a potential support in the future. After higher high, there is an exhaustion phase. The buyers are taking profits and there are small sellers in the market. The sellers make a pullback, a small selling pressure to the downside, then another push phase to the upside, continuation of an uptrend. So this type of market structure, you should only be looking for buying opportunities. The buyers are in control in this kind of market structure. So you buy at higher low. After the retracement is over, you look for buying opportunities so that you can trade with the trend. I will go to the live charts and show you how it forms in real time. So let's go to a downtrend market structure, bearish market structure. It forms a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, as you continue to the downside. Right here is a lower high, right here, the lower low right here, a lower low, a pullback, which is a retracement, then another lower low is breaking this low to the downside. It is breaking this low to the downside. So we are breaking the structural lows to the downside, the BOS, the break of structure to the downside. Where will you be looking for selling opportunities? So at the retracement level, you look for selling opportunities at the lower high. That is where you enter for a selling opportunity. You should only be looking for selling opportunities. Let's go to a consolidating market structure, which is also called sideways or a choppy market structure. It forms this way: high, low, as you continue to the sideways. It indicates indecision in the market. You can either buy or sell. You can buy at support level. This is the support level. At the support zone, you can buy at the support zone right here, or you can sell at the resistance level right here. You can sell at the resistance level right here. This type of market structure is choppy. It is sideways, making it difficult to trade. It is advisable to stay out of the market when you see a sideways, a consolidating market structure in this form. The market is not perfect. It will not form equal highs and equal lows. There might be highs that are taking you out. So this is what we call fake out. It comes back inside the consolidation, then another fake out to the downside. So these fake outs, there are so many fake outs in this kind of market structure. These fake outs are taking traders out of their trades. This is what we call liquidity grabs. So these fake outs are grabbing all liquidities in smart money concept. So it is advisable to stay out of the market so that you can protect your capital. Let's go to the live chart. When you come to the charts, what you want to do first, you have to identify the general market condition, the overall market structure, so that you can be on the right side of the market. It depends with the type of trader you are, whether you're a day trader, a swing trader, or a position trader. So a day trader like me, I always come to the 4-hour time frame. I analyze my market and identify key levels in the chart. Then I go to the 1-hour time frame, look at the market condition at that point. Then I go to a lower time frame like the 15-minute or the 5-minute and look for my entries in the market. Let us see how an uptrend market structure forms. So right here is an uptrend market structure. I'm in a higher time frame, the 4-hour time frame. If I use my drawing tool right here, the trend line from down here coming up here, so even if it touches the wick, it is still valid. The wicks, the tails, if it touches the tail of the candle, still valid. At least 3 touches or 2 touches for the trend line to be valid. So right here we have 1 touch down here, then 2, the 3rd touch at this point right here. So 3 touches. So the trend line is valid. The market is forming higher high, higher low, higher high, higher low, higher high, and a strong pullback, higher low, then higher high as you continue to the upside. So this is a bullish market structure. We broke this structural high to the upside. This level right here was broken to the upside. Then again we formed a pullback, then broke this structural high at this point right here. We broke this structural high at this point right here. There were so many sellers at this point, so there was a strong pullback formation right here. These are called internal structures right here. You can see so many small sellers in the market, so many red candles in the market, but they are small than the buyers. The buyers are big. Bullish momentum is strong. You must know also how to identify internal structures and major structures so that you cannot get confused in the market. How do we identify our key levels like support and resistance? So right here, I'll use my rectangle tool. So I can see a resistance zone right here. So this is a resistance zone at this point. Price came at this point, found a resistance, then made a pullback, went to the resistance, then made a pullback, then price broke our resistance to the upside, then the resistance became support at this point, then price went to the upside, continuing the bullish momentum. At some point in time the resistance zone was broken, then it became support at this point right here. So in an uptrend market structure we should only be looking for buying opportunities so that you can trade with the trend. We were forming a deeper pullback at this point right here, a deeper pullback. So you can even use your trend line at this point to know the end of the pullback. Price breaking it with this strong bullish pressure at this point right here from a support level, this level right here. The price is rejecting this level, which means there are so many buyers in the market. I'll wait for a retest for that trend line, then I'll look for my buying opportunities. So you can't enter a trade in the middle of nowhere. You have to identify your key levels, maybe support and resistance, demand zones, supply zones, and all that. I will post another video how to know chart patterns and candlestick patterns that form on a key level that give you signal for you to enter a trade. So this is another key level. There's a resistance zone at this point right here. Price broke our resistance zone right here and price retested our resistance zone at this point right here. As you can see, our resistance became support. Right here, the structure is the downtrend. The structure is a downtrend. This is a bearish market structure. So if I were to use my tool, a trend line, this is a strong downtrend. As you can see, lower low, lower high, lower low, lower high, lower low right here, lower high, lower low, lower high, lower low right here, lower high, lower low. As you can see, this market condition, it is breaking structures to the lows. Right here, it broke this structural low to the downside. Again, it broke this structural low to the downside. Again, we are breaking structural lows to the downside right here. As you can see, we are breaking structural lows to the downside right here, as you can see. So this is a downtrend market structure. Right here in a downtrend, this trend line is acting as a resistance. The price is touching the trend line, then proceeding to the downside. Our support level was broken and it became now a resistance. So you scale down to a lower time frame like the 15-minute time frame so that you can look for your entries. Once the downtrend was over, this high was broken at this point right here. So this is what we call change of character, market shift in momentum. We are shifting from a downtrend to an uptrend. We were in a downtrend market structure at this point right here, then we shifted to an uptrend market structure right here. Market travels in circles of uptrend, downtrend, ranging. The buyers started losing momentum at this point right here at the top. we are in the consolidation phase. We were trending to the upside, yeah, then the market started to consolidate. So at this point you can say we are expecting a reversal to the downside, which means the buyers are no longer interested in this kind of market. Here we see a resistance key level right here at this point. This is a resistance key level. Then at this point I see a support key level at this point. So the market is ranging. So this is what we call a sideways market structure. It is advisable that you stay out of the market when you see such market situation, because you don't know whether the market is going to proceed to the upside or it is going to reverse to the downside. Yeah, so you will be stopped out of your trade, or you will become liquidity, the stop loss orders. So the market always tends to go and sweep stop loss orders so as to continue in a certain direction. You can both buy or sell. Where do you buy? You buy at support level. So when the price comes to the support, you look for candlestick formation on a lower time frame. Then you look for buy positions. Then you put your take profit in the next resistance level. Yeah, so you sell at the resistance level. You sell at the resistance level. This is the chart of US dollar versus Japanese yen on the 4-hour time frame. After the consolidation was over, the market broke the low, then went down with a sharp bearish move. At that point, then the market came right here, started going to the upside again, being bullish. So it is a circle of uptrend, downtrend, and consolidation. Live chart. So right here, the market is consolidating at this point right here. From this top right here, from this top right here to this bottom right here. Let's say you want to analyze this market. This is the chart of Euro USD. You look at the general market condition, the general market structure, and this one you can do it on maybe a daily time frame or the 4-hour time frame. As a day trader like me, I always start by analyzing my market on the daily time frame right here or the 4-hour time frame. Daily time frame right here. So I look at my key levels. My key levels can be support and resistance levels. So as you can see, the current market condition is a downtrend right here. As you can see at this point, the current market condition, this is a live chart. So the current market condition is a downtrend. Mark up my key levels. I can see a support level right here, right here. So I can see a support level right here. Price came here at this point. Price came back here, then went up, came back again. Now price is bouncing out of this level. So this is a strong support level. Price came here, went up, then price came here at this point, broke my support level. So as you can see, at this point right here, price broke my support level, but this is a fake out. This is a fake out to confuse you that the price is breaking this support level to sell to the downside. They are tricking you to enter for a sell is when they reverse back up with a big bullish momentum. You should be patient in the market and wait for your levels to play. Currently the market is live. I can see that the market is approaching the same support level, the strong support level at this point right here, this support level on a daily time frame. I will expect reaction. You can see a support level right here. Price came right here, price came right here, went up, came again, took a bit of support, then price broke that support. We have a resistance zone at this point right here. So this is a resistance level right here. Let us now go to the 4-hour time frame and see what the market is currently doing. This right here is what we call top-down analysis. So you analyze your market from a higher time frame as you go to the lower time frame to look for entries. So that is what we call top-down analysis. So right here, the current market condition is a downtrend, as you can see right here. This level right here was a support level. Price bounced from it, broke it, then this support level, when it was broken, it became resistance, as you can see. Then price gave us a bearish move to the downside. I'm on a downtrend market structure. So for me to consider that I'm bullish, the market will have to come from this level right here and break that level, come for a retest and continue to the upside. So that one, I'll change my mindset that the market is now from a downtrend and reversing to an uptrend. There might be a possibility that there is a formation of a lower low for a bearish continuation, or the price might just come up right here, break that level, then come for a retest, then continue to the upside. You need to mark your key levels which are near your current market price, because these are the key levels that will help you to look for entries in the market. The market is breaking structural lows to the downside. Don't draw so many lines in your chart. This will confuse you. Make your chart as clean as possible. Use pure price action, looking at the momentum of the candlesticks, then deciding, are there sellers, are there buyers in the market? React to what the market is doing. Remember, you are retail traders. You want to trade with the big banks, with the big boys. Look at the candlestick formation. That is what we call pure price action. Look at the candlestick formation at this key level right here, which is my resistance zone that I identified in the 1 hour time frame. So I'll scale down to the lower time frame, like the 15-minute time frame, then look for my entries. When the price reaches here, I look for buying opportunity right there, stop loss right here as this level, then take profit at this resistance zone right here. So if I'm to enter this trade right now, so that is what I'll do. I'll look for buying opportunity right here, stop loss at this point right here, then I enter the trade right here. Now we are in profit. So that is how you enter a trade. That is how you look for opportunities in the market. Practice patience. Backtest your strategy. Use a demo account to backtest your strategy for you to have confidence in your trading pattern and plan your risk management. You will be able to protect your capital, and protecting our capital as retail traders, as small traders, is what matters in the market. Leave a comment on what you like me to cover next on forex trading.